I think that this is a step to eventually the level of liquidity that we see in the US stock market. The Fed's really making things difficult. The loan amounts are moving so much every month that I truly don't know how much equity I need to raise. They want transparency, they want liquidity, they want choice. All we need is a bridge to get us to fixed debt. Going into a fixed rate, you're moving away from this next 2 years of whatever the Fed wants to do next. You need 18 months to win. I don't think this has ever happened in my career before.
Welcome back to another episode of the Syndication Show, sponsored by PREIshare. My name is Kalani Michelle, and I am here with my co-host, Mr. Christian Sadler, and we have a special guest today, Mr. Neal Bawa.
Yeah, Neal, it's really great to have you here, first of all, and I know that you've actually done transactions with some of the partners of PREIshare, so we have a relationship there, which is kind of nice.
Yes, it's absolutely thrilling to be here for that reason. There's this strong connection that I feel with PREIshare. Actually, was one of the first ones to write a review because I feel like what you're doing is extremely potent. It's extremely necessary. So many people have said, someone should do this, and then nobody did it for a long time. So I'm thrilled that it's happening.
Yeah, and usually I would talk about the different benefits that we bring to the table as PREIshare. I wonder if you can share what you know already about PREIshare and what we're doing, and then I can fill in the gaps for the audience.
I think just speaking from the perspective of investors, right? They want transparency, they want liquidity, they want choice. And I'm not afraid of any of those things. I think in any environment, there needs to be transparency, there needs to be choice. And I think that we've been a little bit of a black box. And I think that that prevents the industry from growing. And I think in so many different ways, Syndication brings that liquidity, that transparency, that comparison. And I think if someone's afraid of that, then maybe they need to step back a little bit and allow someone else to come through. So I think the vision that you guys have put together is going to create a better, more accountable industry to our investors, give them access to liquidity, give them the ability to move in and out of projects more transparently. I think that this is a step to eventually the level of liquidity that we see in the US stock market.
Yes, and that's exactly what we're going for with our liquidity service. It's a benefit to the passive investor, but it's also a benefit to those that are raising funds, right? Because when they can give that type of liquidity, they're more likely to have people invest. I mean, one of the biggest reasons people don't invest in real estate is just simply the liquidity.
Completely locked in, completely illiquid, right? I don't want it to be illiquid. I want my investors to be able to move in and out just as efficiently. I think that you're right. To me, I think like I'm getting 3 out of 10 investors, and that 70% that I'm missing is simply because they're afraid of lock-in, right? And so it's a growth challenge for the industry.
Yeah, and we also want to be an ally for those sponsors out there and help make sure that they have the resources to get things done. So a couple of things that we do for them is our top-off services and our pref equity, which I think you know about both of those. And in fact, I think you've probably even done them yourself.
Yeah, I think it's a fantastic service because what's happening at this point in time is there's challenges happening in the marketplace because of interest rate hikes. So we have these wonderful properties where we might have to raise $13 million instead of $10 million because of interest rate changes. And so we get our raises to 10 or 11 and everything looks good, and then we get stuck. And at the end, when you get stuck, you're just bombarding your investors with information about that project again and again and again. It doesn't really make sense. We lose investors, they unsubscribe. It's just a big loss for us, that final $1 or $2 million for a project. So top off is just a brilliant strategy. And I think that it would be one of your most used strategies as you enter the marketplace and everyone becomes aware of what you're doing. It's just a phenomenal strategy to have.
Yeah, our goal is to be that resource and to be able to help when you do go with an update to your investors, to be able to say we have a plan and we have a solution, right?
Yes, I think that you're a solution provider to the industry at that point, and it's really much needed, especially at this point of time where the Fed's really making things difficult. I mean, the loan amounts are moving so much every month that I truly don't know how much equity I need to raise.
Yeah, that's a big deal. So for those of you who don't understand what we're talking about with top-off services, we are going to approve 50 sponsors. And of those 50 sponsors, we're going to give them access to the PREIshare Real Estate Liquidity Fund. And within that fund, we will do top-off services and pref equity, which is bringing in the funds that you need as a sponsor at the most critical times so that you can move forward. And most importantly, I think, is avoid cash calls.
Yes, and I think that second piece, that pref equity fund piece, is fascinating to me. The timing is so incredible for this because we have a strange environment right now, right? So we've had, the industry went through in 2021, 2022, the greatest rent growth in its history. And I'm talking about multifamily, but that pretty much applied across the board for just about every asset class. So we went through massive increases in rent growth. So that was good. But on the other hand, we have a huge number of bridge loans that are now getting to the point where in the second half of the year, they're going to start to reset. And because of what the Federal Reserve is doing with interest rates, a lot of those properties, which are fundamentally good properties, they are performing properties, they're hitting net operating income, cannot refi due to no fault of their own, right? So you could have said, well, all of these could have been fixed rate. But the truth is 80-90% of all the money that the industry has made in the last 5 years, colossal amount of money, we're talking billions or tens of billions of dollars, has been through the flexibility of bridge loans. So that's what 9 out of 10 operators chose. And well, right now that doesn't seem like a good option. We couldn't have possibly known 2 years ago that this was going to happen, that there was going to be a war in the Ukraine. So now we have this situation where these properties cannot refinance, but because the net operating income is there, the performance is there, if a pref equity piece comes in, then there's enough liquidity for us to roll over into a perm loan. So the property goes from bleeding cash every day, even though its net operating income is running above pro forma simply because of interest rates, and pref equity comes in from Syndication, and boom, the next day the property is cash flowing. That couldn't have happened in the last 10 years. So the opportunity just exists right now, and we're talking maybe 10,000 performing properties that can benefit from this. So that service is an absolute godsend for the industry.
Yes, and this is one thing that we've talked about with our CEO and president, is the one thing that we wished is we started this just a little bit earlier, right? But we are hitting a crucial time where people are looking for these services.
I don't think you're late, because here's what happened, right? So in the first half of 2020, so Q1 and Q2 of 2020, there were no transactions. There was this thing called COVID that you might have heard of. So no one transacted anything. And so in the second half of 2020, there were thousands of transactions, right? Now flash forward 3 years from second half of 2020 to second half of 2023. Well, 3 years, those loans are resetting. And because of the financial conditions, a lot of these properties are not eligible for refinance unless there's a pref equity piece that comes in. So I think that the biggest service that you can perform for the industry is actually in the second half of this year and then Q1 of next year, because that's when the bulk of those properties reset. Once that's done, then we'll have some breathing room. And for now, we're using fixed debt. So the need is going to sort of die away. But I think it starts to peak in Q4 and then Q1 of next year, where there's going to be a lot of good operators with verifiable net operating income levels over performance levels that are going to say, all we need is a bridge to get us to fixed debt. And what's nice is that for the Syndication show and your resources, that's an amazing opportunity. Whenever we put money into a property, we take a risk. We take a risk that it might work out or it might not. But here, this is so unique. By simply the act of injecting that equity and closing on a fixed loan, you're guaranteed to move from non-performance to performance. I don't think this has ever happened in my career before.
Well, and that's one of the beautiful things I think that we're bringing to the investors into the fund, is we're bringing them into something that we have that verifiable proof, and we're bringing them into short cycle investments so they can get a compounding effect on their money.
They absolutely can, and I think the window is short on this. But I recently pitched one of my investors on this, and he said, "Neal, this is absolutely the best thing to do right now with interest rates, because what you're doing is you're getting the best of both sides, right? By going into a fixed rate, you're moving away from this next 2 years of whatever the Fed wants to do next. You're completely insulating yourself from that." but you're also getting away from the will this property work question, because clearly the property is already working, right, for you to even consider it. I mean, if the property is below NOI, just skip that one, go to the next one. There's going to be thousands of them. So the choice is incredible. So I think this is, at this point, the best deal in the marketplace to be inside of a recap fund or a pref fund, as opposed to be putting money into a brand new property and having all these, unknown consequences.
Yeah, absolutely. Well, our audience may not know you, Neal. So before we just keep, diving deeper and deeper, because I love the conversation already, give us your background. I'd love for you to take us all the way back, to before you knew anything about real estate to where you're at now.
Sure. So I'm a geek, a nerd. I'm a computer science professional, data scientist by profession that accidentally found my way into real estate and did it completely backwards. So most people that start with real estate start with a single family rental. In my case, I started with a 30,000 square foot building that I had to build from scratch for my technology company. So my boss walked in very angry one day and said, General Motors, we were tenants of GM, doesn't like what we're doing. All the people that are walking in and out are messing up their carpets. I'm never going to be a landlord again. Let's go and buy our own building and build it. And I was like, yes, Paul, you go do it. And he was like, no, Neal, you go do it. So I was a junior partner. So basically I was handed this job of buying and building a campus from scratch. So it was trial by fire. I made lots of mistakes. Luckily, no investors. It was just the company's cash, and we didn't have loans. And so we made a bunch of mistakes, but we learned a lot. And we were like, wow, this is really great, because at the end of that process, his taxes and my taxes very drastically went down because we had depreciation from this magnificent building that we had built. And the other thing was, because we built it custom for our use, we realized how much money that saves our business. So as soon as we finished building this first one, we went straight into building the second campus, and then we ended up building 6 of them. And so I ended up becoming a real estate developer without having a single investor. And so that's how my story started. And once I got addicted to the tax benefits, right? I live in California. I was paying 55% of my income in taxes, and all of a sudden I'm paying nothing. And I was like, what? This is how can this possibly be legal? It took me a while to dig in and realize depreciation is completely legal and is an incredible benefit of real estate. So then I went through the process of, let me buy a bunch of single families. I bought a dozen of those for myself. Then I started buying them for my family. And then I started hosting a meetup group in the San Francisco Bay Area. And it was a meetup group for geeks and nerds to use data science to exploit the gaps in real estate, to basically hack real estate. And it grew from 4 people to now about 75,000 people that follow us. So it's been an incredible amount of fun, but all across the premise is data science allows you to do better in real estate than anyone else. It's not about Excel, it's about large data sets and churning through them to find locations that everyone else is going to find 18 months from now. You need 18 months to win. And we're constantly churning through those databases, and that's what my group is all about.
That's impressive. So you have a $1 billion multifamily portfolio
That's
now, right? Over 31 projects?
31 projects, we're a little shy of 5,000 units.
Okay, and 10 states.
Yes, and that's the part that's the hardest, right? Because my good friend Michael Anderson, he says, focus on a certain number of markets, focus on what you do. The problem is data science drives me away from that, because data science says, well, this year the best market in the US is in Utah. Well, next year the best market in the US is in Tennessee. And so it forces me to break one of the fundamental rules of real estate, which is get really good at a market and understand it and dive deep into it. And so it's been a hard rule to break, and I've had consequences of doing that, side effects of doing that, but it's worked out for me. So we jump every couple of years from one state or city to the next, and very often we'll only build 2 projects in a city, because by the time we're into the second project, the secret is out. That, at that point it's known that this city is unusual, it has spectacular demographics and spectacular momentum. So that advantage that I have is now lost. I'm just another guy in the city building stuff or buying stuff. So then I have to move on. But that's what my audience follows. That's when my audience says, well, show us your metrics about why this city is so special, what's so unusual. And after 2 years, I don't have that specialization, so I have to move on. So yes, 10 states, and it's a challenge to be doing this in 10 different states.
Now, just to clarify for our audience, your main strategy, I don't know how long you've been doing this, and maybe you can fill us in, and recently especially, is build to rent, correct?
Correct. So, so I'll clarify on that. So, for 30% of our portfolio is to buy properties, and I can tell you it's going to be more than 50% in Q4 and Q1 of this year. For the same reason that we discussed at the beginning of this interview, there's obviously going to be properties that are not going to qualify for what you want to do because there's going to be risk. Well, they have to go back to the market, and we're looking at 25% discount. So at the end of this year, I'm going to be a value add operator all over again. But in the last 3 or 4 years, I've seen that there's gaps in the marketplace on the construction side. So I've finished a lot of construction. This studio actually is very close to a bunch of my construction projects. So there's 2 big ones north of us, there's 2 big ones south of us, and that's been very, very successful for me because there were pockets where it was extremely clear that the value add guys would do well because there was a shortage. But the new construction guys would come into a marketplace and all of their inventory would just get sucked up in a month, right? We've had absolutely astonishing lease ups in Utah where one of our properties had no lease up. The entire property was pre-leased. So we never really opened our doors. We simply went from, certificate of occupancy to next day saying, come on in, right? So that sort of stuff happens when data science points you to like big gaps. So there, obviously, you can make a lot more money a lot quicker than simply buying a value-add property in that marketplace. And as I went through this process of going from being a value-add multifamily operator to a developer, I noticed something. And I noticed this back in 2017 and 18, but it really accelerated after COVID. And that is that for the most part, when you develop a Class A property, you're looking for people with $70,000 in income, and they live in your property for a year or two, and then they buy their own home because the Class A people actually have the incomes to buy homes. So they're only in your property for a couple of years before they go off and buy their single-family home, right? And I started noticing that the gap between their incomes and what a single-family home mortgage cost was increasing. And it was increasing in 2018 and 19 and 20, but it was still within reach. Maybe they had to live an extra year in my Class A before they jumped over, but they could still become homeowners. They could still have the American dream. And then COVID happened, and it completely destroyed the American dream. It absolutely crushed it because from March of 2020, when COVID started, to June of 2022, just in 2 years and 3 months, the price of a starter American home jumped 88%, including the mortgage payment. So if you're getting 4% salary hikes in a year, maybe you're getting 5%, maybe you're awesome and you're getting 10% a year, that's 20% more. But that starter home is now 88% more. So 10 million millennial families that would have owned their own home eventually before COVID can never catch up. They absolutely cannot catch up. The challenge is their incomes are pretty high, so they don't want to live in my Class A property. They actually don't want to live in an apartment complex at all. They don't want to have to deal with marijuana smell and people running up and down the corridors. They want the American dream. So I realized that there was an in-between asset class that was emerging. It's called build to rent. And what this asset class does is it tries to get you as close to home ownership as you can without the apartment feel. And we all started off with single-family built-to-rent homes. Then we realized that was too expensive. We were going above their income level. And so we started moving over to townhomes. So now the built-to-rent industry, for the most part, is building townhomes, 1,400 square feet. So not oversized, right? 1,400 square feet, a little bit bigger than an apartment. Postage stamp size backyard, postage stamp size front yard, 1-car garage, and you can park the second one in the driveway or in the community. But then you've got all the amenities. You've got the infinity pool and the gym and the clubhouse. So they've got that feel of an apartment complex, but they live in their own home and they don't have somebody above them. They might have somebody on the sides, but mostly the noise comes from above. And that is, in my mind, the new American dream. And that's what build to rent is meant to do.
Now, I see a lot of developers with the changes that were build to sell now shifting their market strategy to build to rent.
Absolutely. I mean, Find me a major builder in the United States, any top 10 builder that doesn't have a build to rent division that has been created in the last 24 months. You will not find one. Lennar, KB Homes, pick one. They're all doing it because they realized that for the same reason that I just mentioned, those 10 million families were no longer going to be their customers simply because the gap was too big. They wouldn't qualify for a mortgage. So they're like, we don't want to lose these 10 million customers. So we're going to open a new division and we're going to build these homes for rent, and these 10 million families will still be our customers, but now they're going to be renting in the facilities that we build. And they realize that in the long run, they're going to make more money because as a builder, you never get any tax benefits. You're building a home and you're selling it. The moment you do that, it's ordinary income, right? So you don't get that benefit. But if you take a build to rent community and you build it and you put tenants in it, well, a year after the tenants go in, any money you make on that community is capital gains. So these billion dollar, $10 billion companies are wising up to the fact that that's actually a better market, and there's nothing to prevent them from one day saying, oh my God, the single family market's hot again. Maybe in 2026 it's hot. You give notices to all of your tenants, you move them out, and you sell those homes. So you still have the exit strategy of selling those homes if we have another explosive write-up. But in the meantime, you're earning money and getting capital gains. Every builder in America is wising up to this. 10 million families is a very large market, and it didn't exist before COVID. It's so huge that if every single builder in the United States built BTR communities for 5 years, we wouldn't be able to satisfy the demand. And all of a sudden, abruptly, a lot of them are stopped building because of what the Fed's doing. So we're just making the gap bigger.
That makes sense. So I would love to go back to you and talk about your background in, you did a couple of those developments just out of the need for your company, and then you started this group. Did you immediately go into syndication?
Oh, no. My journey is fairly long. So 2008 is when I finished that second building, right? So I'm like, now my taxable income is lower, huge amounts of cash flow is coming in. And I'm like, I want to go out and buy real estate. And then, of course, all the crash happens. And so my family's telling me, don't buy real estate, right? And I'm like, no. Look at the data science. This is the best time in history to be buying. So my family's like, you're excommunicado if you buy anything in real estate. We're going to basically stop talking to you. And I'm like, I'm going to go do this on the sly without telling them, because I'm like, this looks incredible, right? And because the math was so phenomenal in my favor. And I'm like, if I'm going to do this, I'm going to do this data science way. So I hire like a Ukrainian hacker, and I'm like, there's this website called Zillow or its predecessor. Let's go hack that. Let's go to the Bureau of Labor Statistics. We'll hack that one. We'll draw in all the data into this statistical analysis software called R. We'll churn through the data and we'll try and figure out which city in the US has dropped the most since peak. The peak was somewhere in 2006, and we're doing this at the end of 2008. So obviously everything had dropped. But I was curious to find out which one had dropped the most, because at that point, I'm a newbie to real estate, so I'm reading Rich Dad, Poor Dad and books like that. And the books are telling me that when drops happen, it doesn't drop back to the right level. It goes beyond that. So you end up with this opportunity where things basically go way beyond they're supposed to go. So I'm like, maybe I can find a place where things have gone way beyond they're supposed to go. So I churned through 300 markets and come up with a market that luckily happened to be in my state. I live in California, Taxifornia. And it was 144 miles away and was a city called Madera, California. And KB Homes had built 10,000 brand new 4-bedroom homes there, all very nice brick and, very sexy looking, chic, and basically had told farm workers to apply for loans, no stated income. And by 2008, those people were gone. So half the city had extraordinarily beautiful empty homes, right? Thousands of them, like entire streets were empty. And so I get in my car, I drive over to Madera, and I'm like, okay, how much do these homes cost? Well, you can buy them for cash for $100K. I'm like, how is that even possible? These can't possibly be built for $100K. They're like, oh no, they cost $200,000 to build. And immediately I'm like, this is where it's gone below where it needs to. If something makes $200,000 for a builder to build, and it's available for $100,000, this is the deal of a century. So I'm like, why isn't everyone buying this? And he says, because there's no renters, right? You have to fix the renter problem, and then you can make an enormous amount of money. So I'm like sitting there mulling it over. It's like, how do I get renters? And I'm like, what's the closest city? Because Madera is a small town. And they're like, oh, Fresno's 20 miles away. And it's like, oh, Fresno's a big city, right? How do I get people from there to Madera? So I drive another 20 miles. I go to a real estate guy in Madera, in Fresno, and I say, I want an old house in Fresno. Please sell me an old house. I'll buy cash. And he's like, no, I can sell you brand new homes in Madera. And I'm like, no, I want an old one. And so they sell me an old one for $120,000. And I put that, and I give it to my Ukrainian hacker, and I say, I want this property in Fresno to be on every rental site. And he's like, why do you want so many leads? It's just one property, right? Let me put it on one. I'm like, no, I want it on 50. And he's like, but you'll have a massive number of tenant leads. What are you going to do with that? I'm like, I have a plan. Go do it, right? So the Ukrainian guy spreads it all over the place. He's writing software that's clicking on links so that my property keeps going up to the top. And now I'm getting like 100 leads a day. And so I hired this lady in the Philippines. And this lady's picking up the phone and she's talking to everyone and she's saying, well, that home's rented, but we'll give you a $50 Amazon gift card if you drive 20 miles to Madera. We have 10 extraordinarily beautiful properties there, and you can get any of them for 50% of the rent that you are going to pay for my old Fresno property. So 90% of the people would think it's some kind of scam and would hang up on her. And then the 1 out of 10 would be like, okay, $50, right? Sure, I'll go check this property out. And then they would drive 20 miles, and then they would walk into this brand new property and fall in love with it immediately. And so I didn't own the properties, but the bank that I was working with knew what I was trying to do, because banks were really friendly back then because they had thousands of properties that they had to get rid of. So I basically told them, I will make an offer on a property, but I won't close on it until I get a tenant. And they were okay with that. So now I'm showing a property that I don't even own. And so, I have this person that I've hired for like $30 in Madera because unemployment is high. And that person was showing my properties. And guess what? In 30 days, everything is leased. And I have massive amounts of cash flow from 10 properties. The biggest mistake of my life was I didn't know about portfolio loans because I thought I can only get 10 loans, which is true. You stop at 10. But if somebody had told me that there's this thing called portfolio loans where you can take all 10 and stick them out, now you can do another 10, I would have hundreds of them today, right? But still, I had 10 properties, of course. I went back to my family and showed them this stuff. After they stopped yelling at me, they realized how much money I was making. And then, of course, the family's like, let's go to Madera and buy everything in sight. So they ended up buying a bunch of stuff. And so we ended up with this amazing success story that I was telling people in my meetup, saying, I found this city through data science, and look how much money I'm making. And 2 guys would show up from Apple and Google, because this is in Silicon Valley, and then 10 guys, and then 100 guys. And before I knew it, I had this thriving meetup with everyone listening, and everyone's like, what do you have to sell, Neal? It's like, I don't have anything to sell. You're actually standing inside my technology business, because it was in a classroom of my tech business. I'm just telling you this story because I think it's cool. And they're like, no, you should gather everyone's email address. And I'm like, maybe that's a good idea. So I started gathering email addresses. And then a month later, this guy comes to me and says, there's only 100 people in this room. You should be telling this story to 10,000 people. I'm like, how do I do that? He says, there's this website called udemy.com that has all these online courses. You should take all of your technology, simplify it, because right now it's too difficult. You can't tell people about a statistical analysis software called R, they're going to go to sleep. So you have to find a way to dumb this down and make it something where you can get, look at 10 cities and figure out which one has the most potential in 30 minutes. So I locked myself away, I think 2010 Christmas, in a room for 5 days, and came out with a super easy version of that I called Location Magic. So you could pick 10 random cities that you never heard of, put them through this thing, and over an hour you'd figure out which one was the clunker and which one was the diamond. And I was like, okay, I'm going to record this as a course. So I record it, I stick it up on udemy.com, and I'm thinking, there's going to be 20 or 50 people taking this course. Because by now I was well known in the Bay Area, so I was getting referrals. And I'm like, who's going to refer to this site? Well, 11,000 people are taking that course right now. It just exploded, and people loved the concept and the fact that there was no subscription, there was no, nobody had to pay for anything. It was like a full course with here's all your data sets, and once in a year you have to come to my website and download a new Excel spreadsheet, which also there's no subscription for. And it's just been growing and growing, and a lot of those geeks and nerds that were taking that course were eventually ready to invest with me, and I had their information. So all of this stuff was happening 2010, 11, 12. I'm still waiting to sell my technology business, and finally sells in 2013 to a private equity firm. And while I was wearing my golden handcuffs, because they give you those for a year or two, I was like, I think I'm ready. I think I'm ready to go. And so 2014, 15 were transition years. And it was very fast because I had this massive audience of nerds and geeks already following me. So when I said, I see all these opportunities, and in 2015, all of my math is showing me that there's this city that no one has ever heard of called Provo, Utah, that I think is going to be the most amazing place to invest in. So I'm screaming and yelling at everybody, Provo, Utah, go to Provo, Utah. And a friend of mine who runs a company called Fig is saying, shush, 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 you're telling too many people about our city. But I'm like, no, we have to invest in Provo, Utah. And you know what happened to Silicon Slopes? It started to explode in 17, 18, 19. Prices are going through the roof, and we're building and buying and doing everything in this Silicon Slopes area. And people just followed me in. So my story really started with Utah and then sort of went into other places. But it was validated because 2 years later, the Milken report ranked Provo first. Then in 2020, they ranked it first again. Then in 2021, they ranked it first for a third time. But I was talking to people about it 2 years before that report came out. So that's the power of data science. So now we have a very large collection of nerds and geeks doing this.
So Neal, what would you say is your biggest claim to fame? What are you most proud of in your career?
That I stepped back. So I haven't bought multifamily in the last 2 years because nothing that people were doing made any sense to me. Without naming names, I like Phoenix as a metro, and I was looking in properties there. In 2021, a property was sold in Phoenix for $45 million. In 2022, that property was sold for $75 million. I could not understand how a property could go from 45 million to 75 million in a year. As far as I know, every one of those properties is going to be in default. So it was a big sacrifice. I had this audience. Everyone was willing to give me money. Was super easy in 2021. I mean, you just had to send an email to gather 10 million bucks. And I didn't do anything. And it hurt because you were paying employees and doing nothing. And that's what I'm proud of, that I did not engage in that frenzy. I know 100 syndicators that bought 10 properties in that 24-month time frame. I ended up buying one in a little-known town called Killeen that no one was looking in. Killeen is the primary beneficiary of Austin's explosive boom because it's the nearest poor person metro. And it's been incredible. But other than that, I just could not play. I either had to give up everything that had made me successful and simply just join the fray, or I had to stay outside. It was quite painful, but today I feel good about it.
That's great. So now you're seeing the opportunities arising. Can you give us any insight in what markets to look for?
Honestly, right now every market looks good, and I'll answer your question because I love markets and I love talking about markets. But this is really about discounts. You know, today the average price. So here's an example: a property that cost $37 million about 15 months ago is now 30. So if you do the math there, I mean, it's dropped a fair bit. It's not quite 20%, but maybe 18%. I believe they have to drop another 11 or 12%. And they'll drop because of those crazy properties being purchased in 2021 and 2022 that I mentioned. Now keep in mind, I'm not talking about there being contagion in the industry. Multifamily is in an extremely large space. It's the syndication space which was more bubbly, right? So that's really the fundication opportunity, right? There's these people that maybe overpaid a little bit for their property, but then the rent growth that we saw, that massive rent growth, sort of made up for it. And now you can just get them out of their bridge to perm challenge, there's a way forward for them, right? So good for you. But what happened there is there are now thousands or tens of thousands of properties that you will not bail out. Because you look at the math and immediately say, no, this doesn't make any sense for me. Well, I'm the buyer of those properties now. So because I'm liquid, because I don't have to deal with cash calls, because I don't have to deal with all these stresses on my properties, and I don't have to hoard cash for them, now I can just wait in Q4 and buy. So at the moment, I mean, if I'm getting 28 to 32% discounts off of the peak price, And rents have actually risen since then. So technically, property NOI is higher than it was before. Net operating income is calculated before debt. So so NOI has gone up. Prices have gone down 28%. I'd probably buy everywhere, right? So I think that right now it isn't about cities. But having said that, it's all about your time frame, right? So there's what I call the syndication superstar cities, right? So in Florida, you've got Orlando and Miami. In Georgia, you've got Atlanta, and now some smaller cities like Augusta as well. North Carolina is super hot because they've got Raleigh-Durham, and they've also got Charlotte, and now we're beginning to see Winston-Salem come up. So there's these cities that we've known about for a while. Nothing is fundamentally wrong. We still have people moving out of California. So notice I won't say anything about buying anything in California or in New York, because New Yorkers are flooding into Florida, and you've got Californians going into Nevada and Arizona. And that really it's slowed a little bit after COVID, but fundamentally is still continuing. So there's the reasons to buy into the Sun Belt haven't changed at all. It was just too expensive to buy for a while, and now it's going to be cheaper. So I would say anything in the Sun Belt that pencils out, and it should pencil out lower prices for you, is something that you want to get into. And the timing is really awesome because today interest rates are high, so it's really hard to make anything pencil. But by Q4 or Q1, we think the Fed's going to be done sometime in June. So there's a hike coming in March, a hike coming in May, and a hike coming in June. Those are the next 3 Fed meetings. And we think because of very strong jobs report, there might also be one in July now. They're not talking about it yet, but we think it'll happen. So in July, the Fed says, okay, we've reached the peak. Now they're still hurting the market each month by staying at the peak, right? So the peak itself is hurting the marketplace because the rates are so high that each month they're pushing things down and they plateau. Once they plateau for a month or two, the uncertainty in the market goes away. The market knows where the top is. And mortgage rates don't need the Fed to cut rates for mortgage rates to drop, because mortgage rates are composed of 2 pieces. The piece that the Fed is working on and the piece on top called the spread. The spread is based on uncertainty because the interest rates are based on the piece below. The spread is just uncertainty. Everyone basically picking up the worst case scenario and charging for it. Well, the moment the Fed says, okay, I think we're done and we're going to stay here for a while, this portion starts to move down. We think that Q4 is when that portion starts to move down. So if I put a property in contract in Q4 and drag it out for 6 months, then next year I actually benefit from maybe the first and the second Fed rate cut on the bottom portion, and I benefit from all that uncertainty going down on the top portion. So I end up locking in a much lower rate, lower price, lower rate, by putting properties in contract in Q4 and dragging them out as long as I can. That's the strategy that I think the entire industry should have, because I don't think we're going to get this kind of opportunity again.
It's a lot to unpack.
I know. Sorry, I was rambling on for a while.
Neal, so you were born and raised in India.
That's right.
And take us back to a little bit about what that was like transitioning to the U.S. Did your entire family come to the U.S.? Did your family get into real estate, and then you transitioned into real estate? And where does your family play in the real estate now? Or have they joined you on that side of things? So I know that's a few questions in one, but take us back and tell the viewers a little bit about that transition from India to the U.S. and into real estate.
Yeah, so I'll start by saying my family owns an astonishing amount of real estate, but nothing to do with syndication, right? So the story is our family owned hotels, and one of the brothers in the family, my uncle, moved over to the United States and started buying Burger King. So he bought a couple Burger Kings here, 2 or 3. And I was in the technology side, and so all of the other kids in the family was sort of dragged over into the Burger King business. And so he became sort of a Burger King mafia guy with just aggregating all of these Burger Kings. And so he's doing all of this stuff, and I'm teaching technology, and so they send me over for like 2 or 3 weeks to train a bunch of people. Also connected back to Utah, by the way, because the company that dragged me here to the US was Novell, which started Silicon Slopes in Utah, right? That was the original company that started your transition into a tech economy. So somehow everything's always connected back to Utah for me. So this company calls me over, and I'm supposed to be teaching a bunch of their engineers because I'm teaching all of their courses in India. And one of my certificates don't transfer, and they're like very clear, you can't teach our engineers unless all of your certifications are here. And I'm like, I've been teaching this stuff for a long time. You know that's the truth. They're like, yeah, but here's a voucher. Go take this exam again. Just to check off a box, and then you can come teach our people. So I show up in ponytails and shorts at a testing center in Fremont, California. And I go to the front desk, and there's this beautiful lady sitting at the front desk, and I'm signing up, and she starts asking me questions about Novell, and I answer them. And then she starts asking me really technical questions about Novell. And at this point, I'm fresh off the boat, so I'm thinking, Americans are so smart. The front desk people knows more about Novell than I do, right? I'm like, oh my God, nobody will ever give me a job here. And eventually, I work up the courage to ask her, how the heck do you know all this stuff? And she's like, the front desk receptionist is out for lunch. I am the chief technical recruiter of this company. I recruit people like you. So go get your resume while I'm signing you up for the test. So I come back with the floppy disk with that resume on it, and I hand the floppy disk to her. I go take the test. I come back. She's like, they're waiting for you. I'm like, who's waiting for you? Well, there's 5 people here that want to interview you. So I walk into this room, and 90 minutes later, I've been hired. They walk me up to the floor above where there's an H-1B lawyer. I mean, this is 1997. They're desperate. They're taking people that are mowing lawns and putting them through 2-week courses and making them technologists. And if somebody that is teaching technologists walks in through the door, they just sort of grab you. And before I know it, I'm employed, right? And it just started from there. And 3 months later, I'm training dozens and dozens of people on the same technologies and farming them out to tech companies in Silicon Valley at $200, $300 an hour. It was heady, it was crazy. The stuff that we're doing, it was like multifamily in 2022. None of it made sense because I was hiring 30 people at $30 an hour that basically were tech support people, and then training them for a few weeks and farming them out at $300 an hour, right? So it was crazy. I learned a lot, but it was also completely unreal. And while this stuff is happening, my family is building up their Burger Kings, and they're going from 10 to 100 Burger Kings. And then at one point, they'd realized that what I was doing with construction on the office buildings, right? Because by now I was running the company, they should be doing with Burger Kings. So at what point, they came to this abrupt realization, we are not a food business. We should be a real estate business. So they switched their entire business model. There was some partnering going on between our company and theirs because we were like all realizing the value of real estate all at the same time. And they're like, we're going to build Burger Kings. And the moment they're built, we are going to take the land and sell it as a triple net property, recover all of our money, make cash, and keep the Burger King. So now there's Burger Kings there forever. This is what McDonald's does. McDonald's is a real estate company that makes burgers. And they came to this conclusion, and since then, they've been building 4 or 5 Burger Kings and corner bakeries and Blaze Pizzas. The premise is all the same. You know, as you get richer, taxation is what matters. The only way to get rid of taxation legally is to basically build stuff and then sell the land under. You've created value. Whatever that value is, you keep forever. You can never sell it because you sold the land under it, right? But you took all of your money out. And so my family are real estate magnates, and they've never taken anyone's money.
Now, do they participate in some of the things that you do as well?
No, it's family. So they've let me participate. So it's been one way. I've been a passive investor in their gas stations and their Burger Kings and things like that. But I'm scared because syndication is just such a different ball game. It's very different from what they do. No, not much on my side. I'm pretty happy with nerds and geeks. My family is really good with money, but they're not nerds and geeks. And I really like my investors to be nerdy and geeky. Because right now, for example, some of my construction projects, I've been able to simply go back to my investors and say, I'm debt free. I do not want to get into debt in this environment. Can we just push our projects back a year? Here's all the data. And because they're nerds, they're like, oh yeah, this clearly makes sense. Yeah, that's fine. Just start building a year from now. I think I'd have trouble with that with my family because they're like, every day, let's go, and let's keep building this empire. So I'm glad that the family is not involved. There's 900 syndication investors that are, in the company, and just managing that is challenging. And so I'm not even sure if I want more. They all seem to want to give me more money. So I think I'm pretty happy with those.
Well, let's talk about that then. You have over $1 billion in real estate. Over 900 people have given you money. Over $250 billion invested. And what are some of the challenges that you've run into, and what are some of the big upsides that you feel like your background brings to that?
The biggest one is simply servicing 900 people is extremely time consuming. Everything from K1s to my login doesn't work to, why is my share missing from my portal? It's just a lot. And then updates. 31 projects. We are extremely friendly to investors when it comes to updates. So we've done something pretty painful. We do monthly updates, and some properties we do them every other month. So you're talking about an astonishing number of updates and webinars in a year for investors. So the infrastructure required was very heavy. And early on, I started getting the feeling that we're going to get to something this big. And so I started building an infrastructure. But then I realized that if I wanted to build a true infrastructure, the cost would be too high in the US, right? So I wouldn't be able to scale at the same time. So what I did was, for every person that I hired in the US, I hired 2 people in the Philippines. And so now I have 14 employees in the United States, and I have 21 people in the Philippines. And those Filipinos, they have their own org. They're not part of this organization. They have basically their own company in the Philippines with their own directors and recruiters and people that hire and fire and train and do all of that stuff there. And we're a service organization. They're a service organization to us. So we simply accept the service, but we don't accept any of the overhead. So anything and everything that's overhead to managing and growing that team is done in the Philippines with their own directors. So I was able to attack and take away a bunch of director level people that were running call centers for AT&T and T-Mobile. So they were managing 1,000 people. And they were all working at night because, obviously all the work in the Philippines is being done at night, which is US time, US daytime. And so they were fine with being director level people working at night. And I basically said to them I don't want to do any of the work. You create your own systems, you create your own processes, you report everything to me on a weekly basis. I hate spreadsheets. Everything must be visual. So only give me charts and graphs. I'm very dumb. And now that's what they do. So we have over 100 reports a week that come in from the Philippines in about 20 Slack channels, and that tells us what they're doing, but we're really not involved in that process. But they provide services to us in everything: marketing, operations, logistics. Very small percentage of them are senior enough to see confidential data, but so it takes years and years for us to get comfortable to get them to that point, and they never get access to bank data. Only directors and VPs in the US get access to bank data. But they do have some confidential access to investor information. So we slowly build that up. We've never had an incident. No one's ever stolen money from us. And it's been a godsend. And this team is not, you hear about things like virtual assistants. This person helped me for 2 or 4 hours. That's not this. These people work 10 hours a day. They have medical and health benefits. They have their own training sessions. They all fly into Manila for training. So it's a full org that is built in the Philippines. And it not only makes us incredibly efficient and responsive to our investors, but it allows us to continue the data science research. Like 3 of them simply churn through data. That's what they do all year long. We've culled the list down from 400 metros to about 300 that we're interested in, but they're continuously churning through that. They're the ones making phone calls to people saying, hey, do you have land? Or do you have opportunity zone land, right? Or do you have this property? They're adding more brokers into our system all the time so we can reach out and have access to more properties. And so all of this really goes back to technology. All of this goes back to systems and processes. They've written over 1,000 processes that they follow, and they've written them, right? So this concept of offshoring is very powerful. I didn't want to do it like the real estate industry does, which is I will hire one virtual assistant. I wanted to do it like how Microsoft does it, where really a big part of Microsoft is in Bangalore, right? And they're not just using them to write code, they're using them to make high-level decisions that drive Microsoft. And I wanted to get there, and it took about 5 years to get there, but I'm finally there where they're contributing not just to our company, but to our leadership.
I love that. I've been hiring out of the Philippines for almost 7 years now.
They are pretty awesome people. They're very mellow, they're very chill, ethical. I mostly hire women because even there I was finding that the men were stealing time and the women didn't have any such issues. So I'd say out of 21, there's 4 guys, and sorry guys, but But I just felt like it's all about math, right? So you're tracking everybody. The Filipino culture is okay with big brother tracking of the sort that we absolutely do not allow in the US. So every keystroke, every minute that they're on a computer is tracked. And the data was showing me that the women were more productive than the men, because the men were trying to have another computer with another Upwork account and another bunch of customers. And the data makes it very obvious that they're doing that. So we were like, okay, let's let those people go. They're trying to be entrepreneurs, not employees. And we'll keep our core of folks and basically focus on hiring women in most of the customer facing group, because Filipinos have light voice, so they can actually talk to customers and they sound good. The men had a gruff voice, so it was hard to understand their accent. So we have men in the back office and we have women in the front office.
Love it. Well, so when it comes to syndications, again, what do you see as some of the biggest obstacles?
For new syndicators or investors?
Good question. How about for new syndicators?
I think the biggest obstacle is that the industry has become crowded in the last 3 or 4 years. So there are, from what I can tell, several dozen, syndicator weekend training programs. And Michael Anderson would cringe at this, because learning to do syndication well is really a multi-decade journey. And the fact that a significant portion of everyone buying multifamily buildings today learned it on a weekend, most of which was really a pitch to buy something, is problematic. This has consequences, and we're seeing those consequences. So the industry has become crowded. However, I have good news for the people that are looking to get in as syndicators. We're in the middle of a culling that just started. So we will cull, let's say, some of the people that were just hype-based and was just buying stuff because that got them acquisition fees. We're going to cull them in the next 25%. So there's going to be a vacuum, and there's going to be a chance for people to come in. So this is not a bad time to come in. I would just suggest you might want to be a little patient and wait until Q3, Q4 to buy cheap discounted properties instead of jumping in immediately. So learn, this is a great time to pick up the tools of the trade, but you might want to wait until the second half of the year to actually start making the purchases. And this is a great time to educate. You're new, you've got some investors that are interested. Educate them on what's happening in the industry. Why are they about to get these discounts? And build that sense of leadership, build that sense of trusted advisor status. It's a great time to be telling them bad stories, because those bad stories are going to lead to your discounts later in the year.
And I from hearing your story, I believe that's a big part of your success, is you taught for a long time what the numbers were saying before you ever asked for anybody's money.
Yeah, in my case, it was an extraordinarily long ramp. Like, there were people who knew me and what I was doing for 5 years before they saw that first email saying, hey, I'd like you to give me money.
So what would you say are some of the things that we can look for as a fund when we're limiting in the beginning to 50 sponsors that we are going to allow to have access to our funds? What are some things that we should watch out for on the negative of somebody that we may not want to give money to? And on the positive, where do you see the biggest upside for us in the different syndicators that we could bring onto the approved panel?
Oh, well, I'm going to give you a controversial answer. In normal times, and things have really not been normal since 2015, 16, you look at things like track records, right? That seems to be the guy with the best track record is probably the best. That actually hasn't proven to be the case. When I look at people that I respect in the industry, they don't have the best track record because they've stepped back when the frenzy started, so they lost out on some of that crazy frenzy cash, but they didn't lose any properties, right? And they kept their investors safe. So to me, I think right now for the Syndication show, when you're picking sponsors, it's about mindset. Also, I think you need to pick rich sponsors, because what is happening is if people are not able to use their own money to support their properties, it's a problem. I know of a bunch of good sponsors that are in trouble right now, and they wouldn't be if they were rich. So look, this is all about protecting investors. People need to be liquid. People need to be able to keep cash in the bank. I can tell you right now, I'm a limited partner investor with a lot of people, including Michael's past company, Real Source, his current company, AK Partners. I'm an LP. That's how I learn. I put $100,000 pieces and I watch all these other people do things, and I see lots of interesting things. I'm like, I could do this. I could do it even better. And I take those ideas, right? I haven't done that for 18 months. I am just hoarding cash. I'm sitting on a pile of cash. Luckily, I'm making 200 grand a year because right now a money market account for treasuries makes you 4.35%. That's what you need to look for in your sponsors, like people who see potential problems coming down the road and potential opportunities, and they're willing to not make money right now and just hoard cash because they don't quite know what's going to break. And something might break, hopefully it doesn't, but it might break. And I think that mindset right now is super important rather than the best track record. So that's my 2 cents.
Yeah. So something that you had mentioned is we were talking about good sponsors. And so we have our sponsor approval group, approved sponsor group, where we're doing background checks. We're looking into their historical track records, their communication with investors, if they're getting the K1s out in time, and a plethora of other things. In your opinion, what would you say are some of the biggest things that we should look at when we are admitting sponsors into our approved sponsor group, which we're only admitting 50 sponsors right now?
Don't look at their best properties. Look at what they're doing with the ones that they're challenged. What is their investor communication on those? What are the actions that they took? Are they going back to those properties and saying, we absolutely must get net operating income up, right? They are putting their property managers under tremendous pressure. Like the PM is actually afraid to show up to the weekly call. Those are things that you can figure out by simply studying documents and looking at what they're doing. You have the full track record of what are they saying to investors. So don't look at the good ones, look at the bad ones. How candid are they? Is the ego preventing them from telling their investors the truth on the properties that are in stress? Or are they being transparent and straightforward? You amazingly have access to that information because someone's applying, and so you can basically say, I want to know, show me which of your properties and rank them in the order of which ones are doing the best. And they think that you're going to ask them about the ones that are the best. You're going to basically pick the 3 at the bottom and say, show me all of your investor communication, show me your webinars, I want to go through it. And I think that will teach you a lot about how they behave when they're under stress. It's not their success that matters. It's the problems and how they fix them that matters.
Yeah. That reminds me of something that our president and CEO, Michael Anderson, had mentioned. Where he learns the most is by talking to investors that may not be happy.
Yes.
And they're the ones that just spew it all out, and that's where he learns the most.
Absolutely. Because I think that, I can tell you if the sponsor is good and efficient and clean and straightforward, unhappy investors in a conversation will repeat that multiple times. They'll say, I'm unhappy that my returns haven't come through. I'm unhappy that my cash flow has been suspended. But in the end, I know that these people are trying to do the right thing, and they're telling me all along, they're keeping me in the loop. I don't feel like I'm in the dark. This is what every conversation will feel like for those properties. And if it does, that's a sponsor that you want to give money to.
Communication is so key. And I mean, you've taken it to a whole nother level. For somebody that's more of a beginner into syndications, what would you recommend? Would you recommend the same thing as far as monthly reporting? Or what type of reporting would you think would hold the most weight for their passive investors to want to continue with them forward?
That's a tough one because I want to say monthly reporting, but new syndicators don't have the infrastructure to do it and do it well. So I'd say every 2 months. So right, every 3 months just seems like a lot because you're such a new syndicator that, what I'd say is maybe every 2 months the first couple years, and then you pull it back to a quarter, because the first couple of years is where you're putting the most amount of money, and the investors are second guessing their decision to invest with you the most. So every couple months, property has the story in the first couple of years. There's a lot to tell the story, right? Beyond the 18-month mark, your rehab's completed, and sometimes your refi is completed too. I think you can pull it back. To me, if there was one thing about why my company's been successful, it's investor communication, right? Taking people's money is easy. but keeping them in the loop, making them feel like they're part of the story is hard. And what's interesting is what I've learned is very counterintuitive. The investors are happier when you tell them about failures and problems. There was a gunshot at a property. We tell that story. A dog bit a tenant, and the tenant basically, that cost us $12,000. We tell that story. People want to vicariously live the multifamily business through you. And so telling them everything's nice at the property and you just had an open house or whatever it is fine, do all that picture stuff, but tell them bad stories about the property. And they want that. Without any of getting their hands dirty, they want to know you're getting yours dirty, and they want to see how that looks like, right? So show them the worms.
Yeah. Would you say it would be sufficient to send out an email every 2 months, maybe with some images of the property or images that help tell the story in addition to, the text of the emails?
That's what a lot of syndicators do. I think it's the wrong approach. What we do is we have a webinar every 3 months, and we have two. So we have, month 1 and month 2 updates, and then a webinar, and then month 4, 5 updates, and then a webinar in the month 6. And eventually, once the property gets to the goal, which is 8% cash flow distributions, then we pull it back a little bit, right? But early on, we're very, very communicative, because I find that the webinar is a different methodology than just sending out updates. The other thing that I love to do is that I just fire up Zoom, and then I do a 5-minute fireside chat on interesting things about that metro, that property, something interesting that Chairman Fed Powell said. It doesn't have to be specific to the property. They have to feel like we're talking to them. So why restrict yourself to the property? That's a mistake. Why not just have a chat? Warren Buffett does it, and he's 95 years old. Still communicates with his investors, and sometimes it's just, here's what I'm thinking. Just, what's wrong with that?
That's good information. I love that you do a webinar. It's a little more humanizing and
Yes.
connecting with your investors. 800-900 investors, so they
Yeah.
just hop on whichever.
Yeah,
webinars they
they'll
want.
come in about early in a property. Would get about 40% of the investors watch it live, and then the rest watch the recording. And then late in a process, it's only about 20%. So we don't get a lot when once they have 8% cash, they're fine. Until that time, they've got this pins and needles feel, and that webinar allows them to do it. The other thing is, our quarterly webinars are not webinars. They are Zoom meetings. The difference between the two is, in a webinar, they can speak. In a Zoom meeting, they turn on their camera, they turn on their audio, and now it's personal, right? Even in a property with 50 investors, if there's 40% of them on, that's 20 people. Why not make it personal? And so instead of doing Zoom webinars, we do Zoom meetings.
And I know you do a lot of virtual, but you also go out, you're constantly going out and meeting people. You're at a conference right now. That's why we got the chance to meet with you this time. Talk about some of the ways that you like to network. Are you primarily getting speaking opportunities and that's why you're showing up? Or are you choosing other ways to get yourself out there?
Lots of different ways. So I think that's a big question, so I'll break it into pieces. Number one is, I'm unusual in the industry. As far as I know, all of my peers in the syndication industry have a podcast. I don't, but I have one. I call it Other People's Podcasts. So I've now been on 200 podcasts for other folks, and it's a little challenging because, once they have you as a guest, they want to move on to somebody else. They want to keep it fresh. And so what I do is that each year I come up with 4 to 6 interesting topics that I think that people should know about. And then I write multiple paragraphs and little 1-minute videos on each of those. And then I send emails off to those people every once in a while saying, hey, here's something new that I want to talk about. And if you want to learn more, click here and watch this 1-minute video. And they love it. So I'm back on podcasts more often than anyone else that I know. Some podcasts I've been back 6 times. And I'm fine with that because it gets my message out to a very, very large community of people that are not inside of my ecosystem, right? And then what I do is what I'm going to do with the Syndication show, right? So this is being recorded. So I'll take this recording and I'll send it out as the podcast of the month to my audience. So now my audience gets exposure to this, but your audience is going to get exposure to it as well. So I think the concept of the Other People's Podcast is fairly unique. I don't know if anyone else does it, but I would suggest it to those syndicators that feel like they can bring unique content to the table. And this is not an easy process because you've got to be gathering content and coming up with things that people want to talk about. So there's effort involved, just like there's effort in doing a podcast. I almost feel sometimes early on you put in the effort with a podcast and then you're really sitting back and letting the guest do all the hard work. And here I have to continuously come up with new topics, but then I don't have to have that podcast infrastructure. So that's how I do that. Conferences. So I love presentation because I was a teacher. It comes naturally to me to stand in front of a class and talk and riff. And so I build bespoke presentations. So one of my Slack channels that gets the most traffic is called Design Index. And there are 4 people involved in building presentations, and we build 12 of them a year, so 1 a month. So at the industry's biggest conference is happening here right now, and I'm invited as a presenter. So it works really well to get yourself to the point where people are asking you to be on panels, being on stage. And I know that there's an initial fear of being on stage, and I went through that process, but you get to the point where you really start to enjoy it. Not to mention that there's a $2,000 ticket that I haven't paid in the last 8 years because all of these are expensive conferences, and many of them pay for my boarding and lodging as well. So coming there with unique content is really key because now there were 800 people listening to a presentation that I wrote for this conference called Crisis Bootcamp: How to Use Cash Calls and Recapitalization and Pref Funds to Save Your Property. And then I did a second presentation at a lot of conferences are co-located, so you just move up a floor and you're in a different conference at the same time. And I did one called 3 Economic Indicators that you need to watch for your business this year. So the indicators were inflation, home prices, even though this is a multifamily conference, and cap rates, and which within those indicators what to watch for, and so you can take action. Building those bespoke presentations not only allows you to nurture your investors and give them information about what's truly happening in the industry, so you get that benefit because you're presenting to your investors, but now you're presenting to these third-party audiences. And because we are technologists, as you can imagine, there is a spreadsheet that is supplied by my Philippines team to me saying, these are all of your investors in the Salt Lake City area. They give me a spreadsheet and a map. So now I know where the hotel is, and I know which investors are within 30-mile range. And so I will pick investors that I want to talk with. So this morning before I came here, I was at a corner bakery with investors, and they're slotted to come see me. And I know they're not driving more than 20 minutes, so they can do it in the morning. And so now I have a chance to connect with my investors and come to a show. I also like to do tours, which is why I like Utah the most, because it's super easy, right? Within a driving distance of 2 hours, both ways, I can show people 4 properties, new ones, old ones, in construction ones. And so I never hesitate. I invite people to do these shows with me. I'll grab a 7-seater SUV and fill it with people and go do a 2-hour tour, go back to the hotel, grab another 7 people, go and do the tour again, right? These kinds of things are great. And you might say, I'm a new syndicator, I don't have that. Why? Why can't you show people other properties that you are underwriting? You don't have to buy a property to tell its story. You can simply underwrite a property. You can say, this one got away from me, but I wanted to show it to you because this is the sort of property that I'm going to be buying with your money. Would you like to come see one? The answer is always yes. People love going out to property tours. That's why, open houses are so popular. 1 out of 10 people that go to open houses actually want to buy them. The remaining 9 are just curious. They love what they're doing, but someday they'll be ready to buy, right? So that's how you nurture your investors, by showing them these opportunities and answering their questions. Even when I take them to the properties, I tell them all the horror stories. This property had broken pipes and that cost me $22,000, and then I had a fire in these 4 units. They want to live this business through you. And I think that's ideal. And you may not be, as a new syndicator, be able to tell those stories, but you can tell the story of how you underwrote the property and why this property that you're seeing was so much better than the one that you underwrote that's 10 miles away. Why? They need to understand your thought process. So in a way, you're turning them into investors by telling them stories.
Yeah, it makes a lot of sense. I can speak for the team in saying we would love to accompany you and film one of those. And
Oh,
you know,
they're
go
so
through
much
that
fun.
process.
They're so much fun. They're my babies growing up, right? So it's so much fun to go and look at them because they're all in different phases, right? Some are pre-construction, some are in construction, some are in lease up, some are already leased up, and some have just been sold. So one of the properties I'm showing people is one that I've sold, but now I have a full 5-year story to tell with all of the hair.
Yeah, it's kind of fun to see that through the industry. I've been mostly in, you know, single family fix and flip, and we do the exact same thing. And so to see that that's being done at the larger scale with large multifamily is kind of fun.
I don't think enough people are doing it. So, I have 200 plus syndicator peers at this conference in Salt Lake City. And as far as I know, I'm the only one doing tours. And maybe it's just because the syndicators don't have properties in Utah. I'm very fixated with Utah. A lot of the syndication community is fixated with Texas and Florida and Georgia. So maybe they're doing those tours there. But I just don't think we're doing enough tours. Especially when a conference comes to town. The investors are already there, right? They're already committed, their time's committed. Doing tours is a wonderful thing, and it's also a fun activity.
Neal, is there anything else that you would like to share with the industry as a whole, people that are watching this? What are some of the things that you really want to make sure people are understanding in the current environment?
Well, there's a couple of mantras that I want to give you, right? So, one that's a little funny. Data beats gut feel by a million miles. As you become more successful, you tend to trust your gut more. That is bad. That is bad. There was nothing wrong with the data to begin with. Data beats gut by a million miles, regardless of the experience you have. So remember that, because I have made that mistake and it was very painful. The second one is you can only manage what you can measure. So if you're not measuring something, then how will you compare it? How do you know if it's getting better or it's getting worse? I'm obsessed with measuring everything. I measure everything in my personal life as well, right? I measure how often I have sex. Because this is, to me, to live a perfect life, things are important, have to be measured. And I know I am more obsessive about this as a mad scientist than anybody else, but I think that at a lower level, people can measure their lives because that's how you know you're living the most fruitful life. Don't be afraid of measurement. Numbers are your friend. They're not your enemy, right? And I have a saying that goes with that. This is in Utah. This might get me in trouble. So the Bible got it wrong by one letter, because it is not the meek that shall inherit the earth. It is the geek.
I love that.
Well, Neal, we appreciate you so much coming on. As I'm listening, and the entire PREIshare team that's here right now is listening, I think we're all just in awe at how well you speak, in awe at what a mad scientist you are, in awe of just the knowledge and expertise that you have gained over the years and that you are so generously sharing with all of us. And so thanks for coming on the Syndication Show. We'd love to have you back on. We may even have you back on without you sending out your 1-minute video to us. So
okay.
we'll consider that.
So the box has been checked off here.
Yes.
Well, it's fantastic to be on the show and meet some of the friends that I've had for years. So thank you for having me on.
Now, if somebody wants to get a hold of you, Neal, if they want to find out more about your statistics and your numbers, where's the best way for them to reach you?
My army in the U.S., in the Philippines, the marketing team that I have, make sure that no one else can come up for my name. So Neal space BAW8, hit enter into Google. The first 5,000 articles are about me, and that will get you to where you need to go. If you're really interested in engaging in our community, we have a website called Multifamily University. So multifamily followed by the letter U.com. We store all of our 12 bespoke webinars there. We also have a toolkit that has over 100 research articles and reports. So every time we like a report, we put it into the toolkit. So it's a toolkit plus a dozen webinars, so one a month. And 26,000 people signed up for the webinars last year. So you're welcome to join that community. There's no cost, there's no subscription. It's meant to be free forever.
Perfect. And thanks for joining us for another episode of the Syndication Show. And we also have an investor and sponsor community. Go to PREIshareCommunity.com to join our community on Facebook. And thanks again for joining us on another episode of the Syndication Show.